Hi, my name is John Goldsmith. I joined Montrusco Bolton back in 2004. And one of the greatest things about Montrusco Bolton is the fact that we've got a four-step investment process. We're a highly concentrated, active money manager, and we're focused on risk-adjusted returns. And you hear a lot what risk-adjusted returns actually means, but we're actually one of the few active money managers that can actually quantify why we take the active weights that we do, but more importantly, how we change those weights over time. And I think that's really the special differentiator between how we manage money and how a lot of our peers do. Hi, my background is specialization in the resource space, primarily materials and energy. I've also looked at the industrials and consumer space as well as utilities for well over a decade. A very important aspect of how we operate at Montrusco is the team process. We are 12 people on the equity investment team, of which 9 analysts and 3 portfolio managers. We have a morning meeting every day where we discuss the prior night's activities across different markets globally. And then we have every Tuesday our internal equity meeting where new ideas are discussed and potential additions and deletions are discussed as well. Montrusco Bolton investment philosophy has been something that we've adhered to for well over the last 15 years. It's a 4-step process. The first part is fundamental research, fundamental analysis. And there we're trying to identify companies that exhibit 5 key characteristics. Those characteristics are, first, best-in-class type status. Second is we're looking for companies that are in attractive industries with minimal capacity overhang. We're looking for, on a third basis, companies with strong management teams. Fourth, proven track records. And lastly, we're looking for companies that have solid balance sheets. We're not scared of use of leverage, but we just feel that too much leverage is a key risk. This is the first step, and this first step is key in terms of what we like to define as what good companies are. If a company rates at least 3 on 5 of those 5 criteria, we would look to then pursue the investment and due diligence process, moving to step 2. Step 2 is all about valuation. We look at different types of valuation metrics depending on the industry. Step 2 is key in terms of identifying whether that good company identified in step 1 is also a good investment. At the end of the day, what we're paid to do is try to get a good return on good quality investment companies. Sometimes the valuation isn't there, but that's why we go one step further. We also take a look at what the downside is. So when we're looking at valuation, not only are we looking at the upside potential stock price, but also the downside. And this gives us a ratio that's called the upside-downside capture ratio. And this allows us in step number 3, our portfolio construction, to build portfolios that have the highest potential upside capture while minimizing the amount of downside risk. We feel by doing this, we're completely aligned with our clients with regards to the best risk-adjusted returns possible. Our 4th step is a sell discipline. And typically what happens is if a company has no longer got a 3 on 5 in terms of the investment criteria that we outlined in step 1, and no longer has an absolute return profile that's above 10%, and lastly, doesn't have an upside-downside ratio that's above 1, we would look to completely exit those securities. The equity income investment philosophy basically revolves on 4 key criteria. First and foremost is we need to have companies that have an attractive dividend yield. The current yield cutoff that we're looking is minimum 3.5%. Typically, we've communicated that we're looking for companies that yield between 3.5% to 5%. Historically, we've been able to generate a return over long periods between 7 and 10. We feel that we've been able to generate or will be able to generate a capital gain that's equivalent to the amount of dividend yield in the portfolio. The second criteria in terms of the equity income process is that we're looking for companies that not only can grow their dividends, but also have sustainable dividend payout ratios. This is key because if a company has to cut the dividend, we would look to substantially reduce our positions. Third key point is that we're looking for companies that have lower risk profiles. So not only must they have a high dividend yield that's sustainable and growing, or will be growing, but also have a risk adjustment factor that's substantially less than the stock market. For us, we define this as a beta of less than 1. So the companies that we look to add to the portfolio must be low beta and hence lower risk. This then will provide a better capital preservation, which is ultimately what the fund is supposed to do. Historically, about 70% of the total return of the fund has come from the return of dividend, and more importantly is that the downside capture ratio of this fund since 2007 has been roughly 60%, providing excellent capital preservation in these rough and turbulent times. The last 2 points I'd like to mention is first with regards to the capitalization bias. We're more of an all-cap focused fund, so we're not looking at very small caps and we're not looking at mega caps. But lastly, we're highly concentrated. At the end of the year, we had 26 names in the portfolio and we're currently at 28. Historically, we can go anywhere from 25 to 40 names, and currently we are sub 30. So the investment style that we have for the equity income fund also is based off of 4 criteria. First, as mentioned before, we're looking for dividend growers that have sustainable payout ratios. Second, we're looking for companies that have lower betas. Third, those lower betas typically mean we have less volatility. And lastly, this combines to have a style where the downside capture of the fund is significantly lower than that of the entire market, which means once again, when markets are turbulent, this has a much better capital preservation features and tends to outperform over longer periods of time with substantially less volatility. To conclude, what we have at Montrusco Bolton is a repeatable 4-step process. I cannot stress enough the importance of the repeatability and the fact that we quantify this. This takes the emotion and subjectivity out of the investment decision-making process and allows us to focus on names that we can continually to add and reduce names that we believe expose the fund to greater downside risk. Second is we're looking for companies that have a substantially higher yield than you could get in the market currently. Third, we're looking for companies that can grow that dividend on a very sustainable basis over time. And lastly, we're highly concentrated, which means that we're an active manager. And if you believe in active management, we believe with our process and with the style and philosophy in our equity income fund, we have a product that can provide you superior long-term returns, significant amount coming from dividend, with excellent downside capture in turbulent markets that should provide a greater risk-adjusted return for you in the years to come. This is John Goldsmith from Montrusco Bolton. Thank you very much for watching.